Hello. In this chapter, we talk about inventories and cost of sales. Inventory is an asset account while the company owns the inventory. When the inventory is sold, we have to reduce the asset, and the offset becomes a cost of goods sold expense. So in essence, the inventory turns from being an asset to being an expense. So what I've drawn for you here is my rendition of a fairy. Some people say this looks like an insect, but it's my rendition of a fairy, complete with the little green man look, more than 2 arms and 2 legs, and antenna. So then there's a line through the fairy, and it says, or implies, there are no accounting fairies. So there's no magic in costing items. In Chapter 5, if you remember, we were just told that there were the items had cost a certain amount. But in this chapter, we're actually going to be trying to figure out what cost to use for the merchandise that's been sold. So I point out here, no magic. We use invoices and a costing method to figure out the cost of the inventory we've sold. So we need to consider the 4 primary ways, the 4 accounting ways, the 4 legally accepted accounting ways to cost the transactions of Bilbo Corporation. And I've provided 3 sample transactions. First, Bilbo begins the month, and it's the month of June, as you can see by the next slides, or the next writing on the slide. Bilbo begins the month of June with 66 pair of Air Jordans, that's what the AJ stands for, at $75 a pair. So the $75 is what Bilbo paid to bring the Air Jordans into the store. Certainly Bilbo is not going to sell them for $75 a pair. On June 5th, Bilbo buys 75 more pair of Air Jordans and pays $77 a piece. So the cost price, the price Bilbo has to pay to Nike, is more than $75. It's risen to $77. And then, on June 10th, Bilbo sells 100 pair of shoes for $125 a piece. First of all, notice the sale price is $125. That's what Bilbo charged customers. What Bilbo had to pay was $75 or $77. Also notice Bilbo had to use both what I call tranches of inventory. There were only 66 in beginning inventory. That wasn't enough to satisfy the whole sale of 100. And Bilbo bought 75. Even if, as we'll see with one of the methods, we decided that Bilbo sold all 75 of the new pair, there still would need to be some effort to figure out how much of beginning inventory was sold. So we're going to see the company is not exactly going to be required, it may choose to, but it's not going to be required to figure out the invoice price of every pair that it's sold. So remember from Chapter 5, one sale causes 2 journal entries. The first entry we have is a debit to accounts receivable, credit to sales for $12,500. The way we get that is the number of pairs sold, 100, times the sale price, $125 a pair. We're also going to debit cost of goods sold expense, and we're going to credit accounts payable. But remember, there are no accounting fairies, so I've again drawn a picture of the accounting fairy's face with a line through it, because we're going to have to figure this out. It's a question mark until we determine what the cost price is. Now I'm going to say this again at the end of the case study, but for now I want to point out this number, cost of goods sold expense and accounts payable, cannot be $12,500, because if it was, this company would be run by idiots, and you would know that because the company would not just break even, they'd actually lose money. Well, one of the four methods that Bilbo can choose from to cost inventory is specific identification. So, for example, if Bilbo is a athletic shoe store and it has scanners, cash registers with scanners, and it just scans every pair of shoes that are sold, and it sells some of them from each order, it can figure out from looking at the cost information that comes off the scanner how many it sold from each tranche. So we're saying here, what if the scanner reveals that 64 from beginning inventory were sold and 36 from the June 5th purchase were sold? If we were using specific identification, cost of goods sold would be debited $7,572. Merchandise inventory would be credited $7,572. The way we get that number, 7572, is we multiply the 64 from beginning inventory at the cost of the beginning inventory, $75. We multiply the 36 additional pair times the price we had to pay for those of 77, and then we add those two numbers together, and the result becomes 7572. Another of the four methods that we can choose to cost inventory is first in, first out. Sometimes people shorten the term to the acronym FIFO. And that's, for example, if we don't want to use a scanner, it's a certainly reasonably legal accounting method to just assume. And we don't have to worry about what happens when you diagram assume and the different words that come out. We're allowed to use it. And if we assume, we can assume FIFO. And FIFO would mean we used up beginning inventory first. And if you remember, that means we used up 66 and we had paid $75 a piece for those 66. So that math turns out to be $4,950. We still have 34 more units that had to be sold because 100 minus 66 is 34, and we sold 100 in total. So the 34 additional units had to come from the $77 tranche, and that comes out to $2,618. When we add those two numbers together, we get cost of goods sold expense debited $75.68, merchandise inventory credited $75.68. Companies can also choose LIFO, and it's really beyond the amount of time I have here now to justify LIFO. I will say FIFO can be justified on, that's the way a lot of companies operate. They push the oldest items to the front, they bring the new items, they put them in the back. But what LIFO seems to imply is that a company might sell all the goods that it just got in and leave the beginning inventory to get older and older. It turns out that this can only be justified on the grounds that a company is stupid, that the owners and managers just might grab the first stuff and sell it. And indeed, I have seen stupid companies do this. So a long time ago, the IRS and then the Financial Accounting Standards Board agreed to just go ahead and tolerate LIFO. It's a crime to commit fraud. It's no crime to be stupid. And we're going to see that the reason accountants wanted to say they were stupid and really sold the first items first and kept the last ones to the back is because that turns out, as long as there's inflation, to produce the highest expense. As you'll see, this causes the highest cost of goods sold expense, and as a result, the lowest net income. And if taxes, the tax rate times net income, a lower tax. So here we've got the 75 that came in last at $77 a piece. And you see that multiplication, 75 times 77. Then we have the 25 that were purchased for $75. We add those two together, and cost of goods sold expense is debited $76.50. Merchandise inventory is credited $76.50. So finally, we arrive at weighted average. So when we get to weighted average, what we assume is that we add up both tranches of inventory. What we specifically add is we add up the units, the 66 plus the 75, and come up to 141. We also add up the total dollars of each tranche of inventory. So we've got the $49.50 plus the $57.75. When we get those numbers, we divide the total cost of the inventory by the number of units, and we come up with an average cost of each item, which turns out to be $76.06. Then, when we multiply the 100 pairs sold times $76.06, we get $7,606, and you can see that's the number we plug into the entry that debits cost of goods sold expense and credits or reduces merchandise inventory. So, in summary, remember, this company is not run by idiots. I mentioned it earlier. As a result, the first entry, debiting accounts receivable or cash for $12,500 and crediting sales for $12,500 has to be bigger than the second entry. And indeed it is. The second entry, depending on whether we use FIFO, which produces the lowest cost of goods sold expense, or LIFO, which produces the highest, we're going to wind up with some number between 7,658 FIFO, 7,650 LIFO, and weighted average and specific identification will always fall somewhere in between those two numbers. The bottom I just show you again, the first entry does not equal the second. Let me know if you have questions on this. I hope it was helpful.